great to have all of you here and being in person. It's so exciting. And it is very bright up here. So I'll keep the introductions really short because I really want to hear from our fantastic panelists. Right next to me, I've got Ed Batts, who's a partner at Gibson Dunn. And then one of our co-organizers and hosts, Jamie Leigh, from Cooley. I guess you're just Cooley now.
Just Cooley.
Then you know how old I am now. Jason DiLullo is a partner at Qatalyst Partners, and Irene Liu, who is the Chief Legal Officer at Hopin. So our charge today is to talk about this intense past year that all of you have experienced. And as you all know, global M&A activity is expected to reach a new record this year, building on the second half of last year's record-breaking year. And so the question for all four of you is really, is this pace of activity sustainable? What resources did this past year demand of you and your organizations? And do you feel like people have the bandwidth to continue? So maybe Jason, I'll start with you, but I would love all of you to chime in.
Sure. So I guess being in the M&A business, it's absolutely sustainable. It's going to keep going up and to the right, but we'll just need twice as many people. I mean, if you really think about what's happened over the last 18 months since the V curve came back, it has been a bubble inside a bubble. If you think of 11 years of an M&A run, and then we had 18 months of probably 2x the amount of activity we had before. It's taken an enormous toll, I would say, on the practitioners in the industry, just overworked, et cetera, but I think we can fix that with people over time. But subject to a couple of very large, looming, potentially issues that could slow it down, there's really not a lot of reason that it should slow down. Digitalization of the world is happening. It's happening faster than people expected, and buyers are very excited to add products, add technologies to make sure they're super well positioned for the next phase of the acceleration.
How about you, Jamie?
I think this is our new normal, particularly in specific industries in which most of us play in tech, broadly defined, and life sciences. The way we measure success, the way we pace, the pressure on our companies to innovate and be present with new market meeting products or services is just the way that we have now modeled ourselves. I do appreciate the humanness question, because typically as advisors we get asked for metrics and predictions and our view of what all the Delaware judges were talking about earlier today, and very little about the human side of deal making, which is very real and very important, particularly if you're metrics minded, you want your deal to be accretive, but if you're also human minded, you want the deal to feel good and be successful and well integrated. So I do get concerned about the pace on both the advisors and, like Irene's team, the folks in-house that are doing all the work to not just put the number on the board, but integrate the team. And one of my observations during pandemic deal making is also about humanness, which is, I think people are being more efficient, they're being more effective. It's really about, and I think deal making is also changing too in the background, but it's of course about winning and doing important accretive things, but it's also about making the deals matter and work for the long haul.
Irene, I wonder if you want to give us the in-house perspective, because I know you had an extremely busy past 18 months, and so how was that pace, and how did your team manage it?
Yeah, so I started at this company, Hopin, 12 months ago, and within my 12 months, we've done 5 acquisitions, and so it has been quite a pace, not only for us, but our external counsel that's been supporting us. I do think there is definitely a human capital element that's involved in all of this deal making, but at the same time, from an in-house perspective, it's a way for us to accelerate our product roadmap to be able to move faster than others if you're looking at it from a company growth perspective. And so from our strategy, we believe that M&A is a growth vector, and with the amount of capital that is available in the market, I do think that it will continue to grow. And with this remote culture, it's actually becoming faster to close deals because you don't have to fly over and shake hands with the other founder or shake hands with the CEO. And so a lot of the deal making is happening over Zoom, and so it's a lot faster, and so there's an impact on speed and a way that we can close deals much faster than before.
I would just point out the interplay of the capital markets and M&A right now. So interest rates are low in a macro environment, financial sponsors can afford bids, they're out there, they're competing for deals, and strategics have historically high equity value, so they've got firepower on their balance sheet and in their equity value, right? So that's one part of it. I think that drives it. The other part is there's just very little slack in the system. So from a professional services standpoint, when we live the world of venture capital, IPOs, and M&A, you know, if the IPO window is closed, all of a sudden there's a bevy of mid to senior to junior level associates who are kind of migrating over to M&A and then migrating back to the IPO window when they're offering. Right now, you are seeing a crunch of offerings in the last part of 2021, not just IPOs, but follow-ons, because everybody wants to raise it. We've got a lot of debt stuff going on, and then you layer on top of that your regular M&A flow, and it's a really taxing, healthy thing. I mean, I think all of us, when COVID first started, kind of took a deep breath and went, global financial crisis, dot-com boom, if you go back that far, and instead the past 2 years have just been an amazing pace. And what you're hearing is there's not really a sense that it's going to stop.
Interesting. So maybe we talk a little bit, and I'll ask you, Jamie and Jason, about how the position of sellers has changed this past year. Give a little bit about what did valuations really look like, and how did the trends of this past year impact the advice that you were giving? And I know we've got some data from our friends at SRS Acquium, but I thought maybe I'd start with Jason, and then we'll turn to some of the data with respect to some of the sellers in life sciences sectors and tech sectors.
So it's kind of a complicated thing, but if you think about Ed, really what sellers have today is way more options than they did before in some sense. You have capital markets that are off the charts, giving great valuation. So when you're looking at, am I going to get bought, and you're looking at your alternatives, and really all sellers come down to run really simple analysis. What's the risk-adjusted value to me today of standing standalone versus doing this deal? And when you look at that, the competing dynamics against the strategics, going public, big valuations, investors leaning very much into growth stories and valuing them very high. SPAC alternatives, which are a financing, late-stage financing alternative, even higher valuations, and also more capital even coming to the private markets, staying private longer because the VC funds are much larger, the huge growth funds. So the sellers, the bar is higher to sell now, frankly, than really it has been at almost any point. So if you're an acquirer, the question's from the seller's perspective, if you're an acquirer, you have a much higher bar to cross. You need from a present value basis, your deal needs to be higher across all those various things. And then we haven't even talked about, does it make sense? So the founders actually have more say in their companies today than they ever had before. Part of getting higher valuations is the founders own a lot more. So you have that bar to cross as well. Is the founder and the team going to be happy? Can I make an offer that's compelling enough for this team? And that's probably and I don't see that changing really as long as these valuations and these alternatives stay so active for them.
It's fun to represent the sell side, I'll say that. We have a healthy mix at the firm, and particularly in my practice, it's about 50-50, so I have to be really careful what I say on these panels because...
We have a healthy mix too, it's just 90-10.
So, invariably, I get a call from a buyer saying, why did you say that on stage? We always counsel to really use leverage at the term sheet, and to Irene's point and Ed's point with the speed and sort of the pressure being applied in the market, I think it can get really frothy, and sellers, when they do decide the valuation looks amazing and now is the time, the pressure is on, and I think a lot of sellers tend to give away a little too much and be a little too excited. And just to give a shout out to all of our advisors, even the smallest deals sometimes need counseling in terms of keeping a disciplined pace and a really pragmatic attitude about negotiating at the term sheet stage. So valuation is the key. How much do I get paid? How soon can I close? That's what our sellers want to know. And ensuring that we're really organized, we've got our diligence in tight places, we've got our story down, we know how we're going to sort of stack certain stages of the deal, particularly if we think we're in a regulatory hotspot. I would say being organized and pragmatic and disciplined with speed is really important at the front end. There's also a little bit of a misconception, I think, about rep and warranty insurance, which is not a new product on the market, but a much more widely adopted product, particularly in the technology space by our big buyers. And I think there's an assumption that we can just do public company style deals without having to bother with detailed reps or negotiation, and we'll just fix it with rep and warranty insurance. And that sounds amazing, but I don't actually think that product exists. And their underwriting for rep and warranty insurance is becoming a little tighter and a little longer from a timeline perspective. And I think that it's a very healthy and important piece of deal making these days, but one I think that some of the board members and founders on our sell side clients need to work with carefully to understand, what cannot be covered by insurance. And then the last thing about sell side is really ensuring that you've got clarity of valuation. So we see a lot more stock deals because our big tech buyers in particular. And
Maybe I'll get to our slide while you're talking about that.
perfect. And even our tech company, or life sciences companies rather, have stock to use in connection with transactions. Those valuations have also been riding high for a really long time. But ensuring that you've got great liquidity if you're doing a private transaction, and you've got a really strong level of confidence with respect to the consistency of that valuation. Put another way, is the price you negotiate at the term sheet the actual value you receive when you close your deal, and the same value that you receive when you get any related stock? Those are important strategic questions. I don't know how you feel about this, Jason, but we typically still see fixed exchange deals when we're doing stock deals in the market, and I'm waiting, maybe I'll just dare somebody to try something different in the market. I'm waiting for that to change, just because valuations have been more fluid. To put it nicely, over the past 6 months in particular, I think we'll start to see some pressure there.
Do you see any particular pressures for sort of the life sciences sector? Because I know you do quite a lot of work in that sector.
Yeah, you can see in the data the story sort of tells itself, but there's a lot of creative structuring around how much are we getting up front versus how much are we getting in an earnout or in a public company deal as CVR. And I think we're going to see some more movement there in the coming deal cycle, because people will want to continue to maximize value, and buyers are going to become a little bit more judicious on the life sciences side about where they're putting that. So having really strong conversations with advisors up front about what the right way to strategize about contingent payments is increasingly important. I think sometimes people just say, we'll bridge it with the CVR, we'll just fix it with the CVR. And I always say, a CVR of what? So being careful about the way that we start initial discussions around value, particularly with contingent consideration on the life sciences side, is key.
And I wonder if you want to give us the perspective from the buy side, since you represent so many buyers.
So it's very similar to the themes you had here. I would say, first of all, sellers have options. It may not be a seller's market completely, but they have options, right? So they can threaten you with keeping their head down and doing a financing event. There's finance capital available. They can threaten you with going public or a SPAC now or in a year. They're not completely tied to, oh my God, we got to sell now because it's rock bottom of the market. Point one. Point two, I love rep and warranty insurance. Jamie knows that. She heard it before. On the buy side, I love it not just because you'll get better survival periods, hypothetically. You don't have to sue your founder when you, essentially, indirectly, when you go for your recourse in 11 and a half months when you submit a claim. And, with due respect to our stockholder representative services, the couple that we can choose from, yes, they'll lead the bulwark, but they still go back to like the folks who are working for my client now and say, your client wants to reach into your pocket and grasp this back, and you're not going to get it, and you were banking on it. That's an uncomfortable position for a buyer to be in, and it's a deterrent effect to a lot of claims, especially kind of the ones that are kind of a little bit more than a door ding, but not quite an engine failure in between. And then the other part is, I think it sucks the oxygen out a little bit, takes the pressure off some of the negotiating fervor, because yes, you still have to do reps, but frankly, you have an independent arbitrator come in and do it half the time, which is the underwriter. And the underwriter, if it's one of the 5, 6, 7 most prominent suspects in the industry, and it's just burgeons, so maybe there's up to 20 of them now. But if it's one of the ones that we work with regularly, they're going to say, look, this is what we've seen in our past 20 deals, past 30 deals, all of those in the past 6 weeks. This is what you got to do. And buyer and seller kind of shrug and acquiesce, and life goes on. But it takes so much of that kind of, you're focused on real risk and real problems, as opposed to the hypothetical lawyer corner pocket where we all get around and we say, oh my God, I'm paranoid, and what's going to be my worst day in 11 and a half months from now when I don't have coverage. So I love our RWI. I think it's fantastic. The one thing that I don't think and I think we'll touch on it a little bit, but it's regulatory speed bumps. The largest buyers, who are now in the gun sights of regulators in DC, are going to be a little bit more reticent to just voluntarily walk in on a nice-to-have deal instead of a must-have deal, right? And so, and we see that in a couple of the serial large acquirers in the Valley. I think if you're a acqui-hire type of thing and your magic valuation is 91.5 million, you're happy as can be, right? But if you're at 92.5 or above, or 92 and above, 92 and $1 and above, you know, you got to really think, does my client want to go in and do an HSR filing and be dragged into a potential second request that may have absolutely nothing to do with this deal, but is an excuse for the regulators to potentially go through the back door? And that's true whether it's in the US or we've had a lot of scar tissue from the wonderful regulatory authorities in the UK, if they're watching, hello. But they also have a very forward-looking, you know, they're dragging deals in the UK in for review that have no nexus to the UK, no turnover revenue in the UK, are completely outside the UK.
But it keeps the regulator busy.
Yes.
Yeah, we'll have a specific discussion on sort of the regulatory issues in a little bit. So Irene, going to you, strategic buyers were obviously very active, as you talked about with respect to your company. Could you give us the in-house perspective of the factors that really proved critical for you in terms of actually executing your deals?
Yeah, I think largely, like I said earlier, the remote factor was incredibly important for us. So we are a fully remote company. And so to bring in a completely new company in a remote environment is a lot easier to do, because previously, pre-COVID, when you're in a location, then you want to look at targets that are near your location or some remote location that is strategic to you. Whereas for companies like ours and for many companies that are now remote, you have a global footprint that you can look at for targets in all different parts of the world. And so what we've been doing is when we look at M&A, we're looking at a global a list. And so I do think that offers a lot more in a remote environment than in the past. I also do think integration is a lot easier, because when you're in a remote environment, then you don't have to physically onboard a whole group and figure out physical space. And so a lot of the remote pieces of post-COVID world has been incredibly helpful in deal making for us, and has been a strategic accelerator for us when we're looking at M&A, because we can culturally bring in a lot of teams as well because of this remote nature of our team.
Do you think the cultural integration is actually easier because of the remote aspects?
For us specifically, we're in 45 plus countries, so we're very global in nature. And so because we're in 45 plus countries, oftentimes it's one of the targets in those 45, or if not, it's one other additional country for us. And so in that sense, it does open up a lot more. Cultural integration is never easy, and I think it's something that you should definitely factor into. But we have a very low ego culture, and so our founders, when they're talking to the sellers who have a lot of options, it is a dance, but at the same time, I do think that the low ego culture plus the remote factor has been an accelerator for us as well as other buyers in the market.
You saying the same thing in terms of that for your clients, Jamie, in terms of cultural integration and a remote environment?
When our buyers ask us what to do better to make themselves more competitive or stand out or get a better reputation in the market, we always tell them, don't screw up the employee piece. And they usually nod and say, yes, 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 we have an HR team for that. And I say, that's not exactly what I'm talking about. And then we do a couple deals together and they say, how do we do this better? And I say, don't screw up the people piece. So I think the integration and the people part of it is the number one easy to miss or easy to underemphasize piece of getting the bang for the buck out of M&A. And it is really, I think, this generation of deal makers focus in a way that maybe historically it wasn't quite as important or top of mind, but I feel a new way of deal making coming together such that those employee pieces, maybe not in Ed's client base, but for the strategic buyers, I feel, I'm just challenging you for the next go round, but I do think that the cultural integration piece is top of mind, particularly since we can't be together. People are finding more creative ways and putting them at the top of lists in terms of execution. And it's really wonderful to see, because I think it keeps the flywheel of what we do, particularly in the tech and life sciences sectors, really robust and healthy.
Can I add something, Jamie? Speaking from the sell side, by the time you sign that agreement, and working with lots of founders, lots of companies, so by the time you sign that agreement, they have made up their mind what that cultural integration is going to look like. So you're either with the flow or you're working against it. So what I would tell you is the way you interact as a buyer through the process, the way you negotiate, the way you get the term sheet done, the way you talk to them about how you're going to retain people, the way you interact with those people, how you get on calls, the way the calls work. They have made up their mind 99%, maybe not 100%, but 99% about what it's going to look like. And if it's bad, then you're working against that the whole rest of the time. And if it's great, you have that as a push sort of behind you as a wave.
How is that different this past year versus any other year? In the sense that you're doing a lot of this much more remotely than you were doing sort of the in-person meetings and so forth. So I'm just curious, did it differ in any kind of way that was meaningful?
I think there's a little bit more vetting you have to do from a cultural perspective, because you can't physically see the office space. You can't really see how the founder interacts with the team or how the CEO interacts with their executive team. So there is a lot more talent diligence that you have to do to understand the culture a little bit better, because it's a little bit harder to dissect. The other thing that you have to figure out is, especially if you're acquiring a foreign entity, a global entity, is the English. Like, can they actually speak English? Do they speak English to be able to integrate and work with our teams? And so a lot of that vetting has to be done up front. So I do think that there is a level of diligence that's probably not the same, that still could be done over Zoom, but you really need to carefully watch.
And do you want to chime in?
Look, at the end of the day, for tech deals, the overwhelming value proposition, the overwhelming component of value is human capital. And so if you're going to erode your human capital value from the start, you're eroding the whole thesis of why you're doing the deal. So I violently agree with everything that was said in terms of keeping things civilized, cheerful to some degree. But most importantly, like, if you say the offer letters are going to be ready on a certain date, the offer letters are ready. And people have actually ticked and tied through, and kind of M&A HR is talking to regular HR is talking to benefits, and we know how the porting of the healthcare and the porting of the 401k and all of that is going to work, because that's actually really, really important to rank and file engineers. The top 3, 4, they have confidence that they'll be taken care of and life will go on. But rank and file engineers, they care about their little 3 feet, right? So give them their 3 feet.
So we'll talk a little bit about SPACs, because I know you brought that up. And they were all the rage for 2020 and perhaps some of 2021. But how did the sort of the SPAC phenomenon impact your clients' strategy and model development with respect to M&A? Sort of, how did that phenomenon sort of impact your clients specifically? And maybe, Jamie, I'll start with you first from the sell side.
So for a lot of the sellers, it created, and probably for buyers too, it just created this additional layer of competition or alternative thinking to do. And I think a lot of our founders found themselves in board meetings where board members would say, well, why are we doing a SPAC? And it was like, everybody's doing a SPAC, why aren't we doing a SPAC? And so I think it was pretty distracting. My personal view is a lot of companies are not ready to be SPAC candidates, but a lot of companies think they are ready to be SPAC candidates over the past year. And so it was very distracting, I think, to a lot of folks who either had a mindset that a sale would happen at a certain event or past a certain period of time, or that the standalone was getting sort of better and better every year with the weight of the market behind it. So from a sell-side perspective, there was a lot to consider, and I think a lot of spin in the market that was difficult for people to really fully assess. With the hindsight that we have now in the market, I think people are doing better at those assessments, and so when you get asked, should I be doing a SPAC, I think we have a little bit more look and feel than we did when the craze began.
Was it different for clients in different sectors?
I think for sure that much more much more heavy and weighted in certain sectors or even in certain geographies or with certain kind of investor mixes. I mean, one of the things that we say now is what we're really looking forward to in the future after the SPAC craze is we'll have a whole new rash of targets to work with, whether you're on the buy side or the sell side. So I think it is sector dependent to some regard, and you can sort of see the waves, but really to Ed's earlier point, it's just about optionality.
How does that optionality impact your clients' decision-making on the buy side?
I'm not sure it does that much. I do share Jamie's enthusiasm that if you look historically, you go back 20, 30 years, and this is stuff I've quoted in the past, we had 8,000 public companies in the United States that shoveled down to about 4,000 plus 400 FPIs. The wave of SPACs, the wave of IPOs, that's going to materially increase the pool of kind of well-capitalized, reputable public companies. That 4,000 number, 2,000 of those are under 750 million in market cap. So they're not effectively, they don't have huge in-house legal departments. They're not continually doing deals. So if you're looking at a population of, say, 2,000 ordinary course public companies in the U.S. covering all sectors, and then you add to that just 10% of that, it's a lot. So we say it tongue in cheek, but it will be an interesting time in the next 12 to 24 months as some of these SPAC deals kind of have to stand the test of time and see where the financial results are and what that means to them strategically.
Do you see, Jason, a whole bunch of new sellers?
No, just maybe to comment on the buy side on SPACs when we do them, they're not competition on the buy side. Actually, you look at them as if the seller's talking to you about my SPAC and this is what I'm going to do, and you say, fine, go do it. And then we'll have a public market benchmark. And then a quarter later and 2 quarters later, we'll see what that public market benchmark looks like. So I think it makes it harder, actually, to have sellers a little bit in the near term because the valuations can be volatile. And volatility in a valuation, when people look in a rearview mirror and they're thinking about doing a deal, makes transactions more difficult unless the SPACs go really well and then they go up and then people come and say, okay, the value is there, the investor saw the value and I'm going to pay for that. So it absolutely creates a lot more targets over the long term. In the near term, it just makes transactions a little more complicated because you've set some valuation benchmarks and either they'll be underachieved, in which case it's hard to pull it off because you've sold stock at a certain value. And if they do well and the stock goes up, well then great. Well then everyone's seen the value and it makes it great from a sell side perspective because then you have an objective valuation to point to. So yeah, I think it's a little bit of a red herring from an M&A market perspective in some ways. It has created a ton of cycles. I totally agree with Jamie. It's probably bogged boards down way more than they needed to be, but it's a great product for a lot of companies and it's a source of capital that really wasn't there. So it's worth spending the time thinking about for sure.
So Ed, you turned us and talked a little bit earlier about the increased regulatory scrutiny both in the U.S. as well as internationally. And I know we've got one slide that sort of talks specifically about the additional antitrust scrutiny that we're going to see specifically there, with the regulators really turning their sights on both prior deals as well as current existing deals and sort of indicating that they're going to go after transactions a little bit more aggressively even in the coming year. So maybe you can talk to us a little bit about the sort of cross-border perspective, and then Jamie, maybe you could touch a little bit about on the issue of how do these concerns, and particularly antitrust concerns, impact the way you advise your clients right now?
Yeah, so I guess from a cross-border standpoint, i.e. non-U.S., I break it into the U.S. analogs, which is you have antitrust and kind of national security approvals, right? And both of those, especially national security approvals, are becoming more and more prominent in continental Europe and in the UK. So I've done in the past year a national security deal in France, one in Italy. The UK has the National Security Investment Act, NSI, coming into effect for deals that close on or after January 4th. And that's going to be kind of a mandatory FIRMA type, which is the updated CFIUS, kind of super CFIUS regulations for mandatory filings in certain critical sectors. That'll apply in the UK as well. So from a national security standpoint, it's more hoops to jump through, and they're much better funded and much more organized, and they've got people physically looking for deals that don't file and asking questions about that. And so it's something you need to keep in mind if you're in, for example, semiconductor supply chain of various sorts. I think that's something that's gotten a lot more scrutiny and attention. data and where's the data residing, where's the data lake housed, et cetera, things of that nature. On the antitrust side, look, I will defer to some of the media reports, et cetera. Clearly, I think larger serial acquirers, like I said earlier, are thinking, you know, what's the nice to have, what's the must have, and what's worth the investment in going through the HSR process. There are deals out there by all the large serial acquirers that exceed HSR. They haven't stopped dead in their tracks. But I do think, like, for a $200 million deal, are you going to want to march in and open yourself up to that type of HSR exposure? You might think twice.
I think in particular, it's also about watching some of the competitors. So we live, whether it's tech and life sciences sector, in a set of industries that are geared towards being innovators and disruptors and new modelers, and that's not going to change the DNA just because there's a regulator somewhere that says, I'm going to look more closely at your deal. I do think it changes the priority stack of some of the deals or the order in which people are going to go after deals to ensure that the way that they're sort of positioning themselves to whatever regulatory authority remains both consistent and achievable. So in some instances, that means doing the harder deal first. In other instances, it means sandwiching in the middle of a bunch of totally easy to ignore transactions and everything in between. So what we're spending a lot of time doing with our buy-side clients is better understanding their playbooks for M&A and what comes in what order and what are other competitors doing to describe their market presence. You know, we're still in this space where we're defining what certain technologies or life sciences assets really are, what they're used for today versus tomorrow. And I still think we're in really an education space in the dance between clients and regulators, ensuring that there's strong understanding of sort of what technologies do or do not do. And the other piece that's important is to understand that that the marketplace also has a place with respect to investor sentiment relative to certainty to closing. So if we're doing a deal that's going to catch a lot of press, maybe it has to do with the regulatory piece, maybe it doesn't, but we're spending additional time thinking about investor sentiment in connection with confidence to closing. Whether your deal is public or private, all of those things really matter. If you're one of these big buyers in the crosshairs, or you're just an up-and-comer that is going to need to become very active from an M&A perspective.
Irene, how does it impact you from an in-house perspective? The sort of the expectation, I guess, in some ways, of increased regulatory scrutiny.
It's definitely a factor that we need to think about for every deal, and I think we have to time that when we think about the deal pace. Again, for most high-growth tech companies, we want everything to close as fast as possible, and given how frothy the market is, you also want those deals to close as quickly as possible too. So we're trying to figure out the timelines with the help of our advisors as well to make sure that it's realistic and factoring in these regulatory aspects in our deal process.
Although there is a certain elegance to having that full 30-day waiting period, which has been in effect for the past year, because guessing like when are you going to get early termination, is it going to be in 48 hours? You have a date certain and you know you're not closing before that, so at least let's get the rest of the work done and be ready for it.
Can I ask you both a question that is related to that, which is how does it impact sort of the drafting of the deal documents and sort of the negotiating of the actual definitive agreements and so forth?
I have never spent more time on the antitrust-related language in my life, which is intellectually interesting, but getting to be, I think, a little bit tortured to some degree. So I'm ready for a few more deals to keep moving through the chute and from all regulatory perspectives, so that I think in particular on the sell side, there's a lot of, well, I'm paying this much, so just take it. And that is very difficult to take if your deal has 2 zeros behind it or a billion zeros behind it. And so there is a lot of tension, I would say. I think we'll move through that as we start to see more patterns in the regulators' behavior.
How about on your end?
The drop dead date, I think, is
Yeah.
a little bit more susceptible to pressure. Part of that's because it's a seller's market, right? And so if you're going to get dragged into a second request and be hanging out there for a year, some sellers want to say we want to pull chocks and we want to have optionality after some ridiculously short period like 90 days. And so we have to deal with, is it 90, is it 180, is it 180 plus 180, is it 365, that type of thing. But I do think I agree with Jamie. We're spending a lot of time these days looking at regulatory covenants and drop dead dates and the interplay.
Jason, are you seeing that when clients are kind of coming to you in terms of like right at the very outset, is the potential sort of regulatory scrutiny impacting advice giving?
No, absolutely. It depends on the sector too. If you're anywhere in the global supply chain, absolutely. If you're touching China, definitely. If you're anywhere near UK, EU, basically anywhere in the world.
Yeah, I was going to say that covers a lot of the world.
It's like, I think Ed's point is really important. It's not just antitrust. It's absolutely foreign direct investment and other types of barriers going up to protect AI, data, and all these other things. So you don't have a discussion these days without thinking about that early. Or if you do, you've missed something, to be honest. Like you really haven't, if you haven't spent enough time on it early, you will get bit by it later, or maybe not that deal, but as advisors, you will definitely get bit by it if you haven't planned ahead on all of them.
So I know we're supposed to be looking backwards a lot during this panel, but I also wanted a little bit of thoughts, because you touched upon this a little bit, Ed, earlier, about should we expect any kind of a cooling down effect? It seemed like none of you were expecting a cooling down effect, but we might have some slowing down of the equity markets. We've got structural macroeconomic issues. We've got inflation seeming to rage, as well as this sort of enhanced regulatory environment. So what are you predicting?
No pressure.
I look at the,
No pressure. We're going to hold you to this next year.
So the junior bankers, aspiring amateur financial prognostications. I mean, look, absent some radical turn in kind of the quasi-Goldilocks environment we're in, I agree with what Jamie said at the outset. When you're in tech M&A, there's a secular focus on digitalization of the world. And you go to the East Coast and they all talk about we're going digital, and I'm like, what's going digital? We're in tech. Right? No, we're going digital. Okay, we'll sell soap bars over the internet. I got it. And so that type of continual deal making is going to just thrive, I think, unless we have a really adverse black swan market event, which, hey, we sure could, and a correction of, say, 15% or more. But given where valuations are, given where the interest rates have to go to really dissuade financial sponsors from taking loans down in LevFin, then I think we've got deals ahead of us. And to Jason's point earlier, yeah, it's a reason why we're recruiting heavily and trying to bulk up on our own human capital so that we can deal with this without us all working nights and weekends every single month for a continuous amount of time.
What's your prediction?
I definitely think we're staying very hot for the foreseeable future, and I also believe that the last time we even had a modest slow down, which was hardly a slowdown, a lot of buyers sat out thinking I'm not paying those crazy valuations, and what they realized is they missed a whole cycle of growth, whether that was talent or tech. So here we are. We're going to figure out a way to keep moving at this speed.
You're ready to keep going? 90 miles an hour?
Look, I think you have to separate two things. One is volume, number of deals versus size of deals. So you can have a correction, you can be doing twice as many deals. And M&A is very much correlated to upward markets. But by the way, a really bad market that's been bad for a while is not bad for M&A either in the grand scheme of things. So while you may have some volatility up and down, anytime you have, and speaking just for tech and maybe for life sciences a bit as well, anytime you have an industry that's this dynamic, that's going through this many changes and is impacting retail, consumer, fintech, so many other industrial, so many other industries, by definition, it's going to continue to consolidate. And the fact that maybe some of the big people are having a harder time doing some of that is actually, sorry for the big guys, but maybe better overall for M&A, because you'll see more companies, you'll see more activity from some of the buyers who maybe said, I don't want to be in that market because Amazon's going to own it.
All right, so we have like a minute and a half. So rapid round, very, very quick. Irene, I'll start with you. One very useful, constructive takeaway from last year.
Again, I think just what Ed and Jamie said, human capital is incredibly important as you're thinking about integrating. So I do think you have to put that level of effort in to onboard them successfully, because a successful M&A and its results will not happen without humans that are engaged, excited, and pumped for the new company as well.
What about you, Jason?
In a world where the markets keep going up, and or at least where a lot more stock is being used because valuations are high, absolutely have to think about the strategic value of the deal that you're doing, as well as what's going to mean for the employees afterwards. Cash deals are all equity generally for employees too. So don't lose sight of the fact that what's the combined company look like for both your company, their company, and the employees.
I give a big high five to the effectiveness of deal making over the last year, and I really encourage us to stay very efficient, very collegial, very focused on the business goals, and I'm excited to see that trend continue.
Agree with all that. I just say plan beyond the signing, right? You get to the signing, there's like a exhale, but to Jason's point earlier, if you haven't really pressure tested some of the things that's going to happen between sign and close, that's where we've been having a little bit of hiccups here and there.
Well, please join me in thanking our 4 great panelists. This was really informative, and thank you.
Good.